Welcome everyone to another In Conversation. We're hoping this one appeals to many of you and a topic that you might not know much about, but could well be excellent for you. My name is Ed and I'm back in the hot seat after a short stint away to help steer us through this conversation with a couple of veterans of the industry. This will be a fast-paced 30-minute session with the focus firmly on self-managed super funds and what that might mean for practice purchase. As always, there are pros and there are cons, so we'll give a balanced view on what it means for everyone. And while a balanced conversation is always good, please remember that what we discuss today is not advice and is general in nature. Before we get started, a reminder for me that this is a conversation and the live event Q&A section on the right-hand side of your screen is there for you to submit any questions to the team. The curlier the question, the better. These guys are experienced professionals. Click that button with a couple of speech bubbles and question mark to activate the panel if it's not there already. Android users, there will be a slight audio delay when you type into that Q&A section, but that audio will return. My colleague Lyndall will be there typing some comments, so feel free to follow her lead at any point and throw in any questions that you like, and I'll put them to the team in the Q&A at the end of this session. So who are the two industry veterans we're hearing from today? First up, Craig Spiegel. We call on Craig for the more technical In Conversation sessions, as he never seems to be rattled. He knows what is best for his clients and likes to work his way through all options. Then it's Kelly Gore. Kelly fields call after call on the subject of SMSF lending and leaves no stone unturned when establishing the right solution for each client. We look forward to hearing what she has to say on this particular topic. Once the team have wrapped up, I'll be back to moderate the Q&A, so please keep those conversations coming in using the live event panel on the right-hand side. So in this webinar, we'll expand upon our ebook, A Guide to Self-Managed Super Fund Lending, which we designed as a starting point for you, providing clear and readily accessible information on borrowing out of your SMSF to acquire your practice premises. We feel there's a lot of misconceptions of what you can and cannot do in a super fund, and there's plenty of change in the marketplace in the last 12 months. So we thought this might be an opportunity to share what we know. So first up, let's head to Craig to tell us a little bit about what's involved and really what's it all about. Hi, Craig.
Thanks, Ed. The SMSF is always topical, as for most of us, this is the main vehicle to build our retirement nest egg. It's a structure which provides preferential tax concessions and where the capital is locked away for a very long time. It may not be as advantageous as it used to be, however, most will agree it's still the best game in town. It enables creation of wealth in a tax-efficient vehicle. For our clients in particular, it also provides stability and asset diversification, and for some clients, it's even been a means of raising capital. Kelly will touch on that a little bit later. So, where do people typically start? Almost all of us start with a retail fund. This is where our superannuation guarantee benefits are paid by our employer into that retail fund, and any salary sacrifice contributions that we make also typically go to that fund. At a later point, often with a spouse or partner, your advisor or financial planner might recommend the establishment of an SMSF. That's when your retail funds reach a certain size or value. Or there's a particular event or catalyst such as purchasing a property. The ins and outs of establishing and managing an SMSF is pretty dry stuff, and so I don't intend on getting into too much nitty-gritty right now. But you do want to make sure that you have the right advisors to provide the appropriate guidance. A financial planner, lawyer, accountant, etc. Each have their own role to play, and it's important that you have a good team around you. These are the people who can help create your fund, assist in developing a financial strategy, and make sure it's compliant, amongst other things. You can take a look back at page 4 of our guide to get an understanding of the basics. It touches on various things such as structures, trustee requirements, LRBA or limited recourse borrowing arrangements, ownership of fund assets, bare trusts, etc. We recommend consulting with a dedicated tax professional to decide if setting up and ultimately borrowing through your SMSF is the right decision for you. Kelly will now touch on some of those changes that we've seen.
Thanks, Craig. What's that saying? That the only constant in life is change itself? There's certainly been a lot of this in our lives this year, there's no doubt about that. But over the last 12 months or so, there's also been plenty in this area of the market, and keeping up with the information and the actual impact of these changes can be tricky to navigate. One significant change in the last half of last year was that many lenders actually withdrew from the self-managed super fund lending space. These loans provide an additional layer of risk to the lenders as they're unable to have recourse against anything other than the assets themselves. Put simply, they're actually unable to engage with the borrower or any associated parties to recover any potential shortfall in the event that they have to force sale on the property. What's particularly of interest is that many of these lenders were also the ones that actually needed a 35% deposit up front. So they'd already mitigated quite a significant risk with substantial equity on day one too. While borrowing less can result in a lower monthly commitment and overall interest payable, the flip side is it also means that without a sizable deposit, many clients could be locked out of a purchase by being unable to meet this lending criteria. I'm proud to say that I'm part of a team which found a solve to this dilemma for many of our clients by introducing a 90% loan to value ratio product to the marketplace about a decade ago. It's something we continue to offer, and even during these times, and always will, as it makes sense for our clients to be their own landlord. I've also seen an increase of clients calling for assistance as their current lender obviously is withdrawn from the market, so they've been told they need to pay out their loans or seek a refinance alternative. Traditionally, most lenders would have grandfathered these existing loans as they'd had a change in policy, which means as long as there was good conduct and they were happy to keep these loans running until the clients completed them or they paid them out. But it's apparent this isn't even an option this time around. With those few who do remain in the space, the lending criteria is even more restrictive now than what it was even 12 months ago. This certainly makes for a stressful time to find an alternative. These two restrictions particularly sit across liquidity ratios in two areas. The first is the minimum fund size prior to settlement of the property. This means you can't even apply for a loan without having a substantial value in your superannuation. This basically cuts out a whole generation, particularly postgrads and specialists too, who cannot access this type of lending as they just haven't been in the workforce long enough to build up their superannuation fund. The second part of the requirement is actually at the opposite end, the value in the super fund at completion of the property settlement. Clients are expected to demonstrate surplus funds of anywhere between $250,000 to $500,000 before obtaining an approval and ultimately the settlement. And please remember, in a traditional environment, $1 million property would need about $350,000 deposit and stamp duties up front, plus that additional surplus to be evident at completion. It's a substantial and meaningful commitment, and once again, limits the number of people who can access this finance vehicle, Ed.
So thank you both for your opening comments. Now, as most things in life, there tends to be two sides to a story. So without starting a fierce battle here, I'm going to ask Kelly and Craig to run through what these might look like. So let's head first to Craig. Craig, are you going on the light side of yes or the dark side of no, the good cop or the bad cop?
Ed, always the bad cop, no problem. In short, buying property via an SMSF structure is more restrictive than buying the property in your own name or a trust, for example. In the SMSF, you cannot leverage the equity that you create. You can't raise funds against the property once you've paid it. In other words, you can't redraw any extra money that you might repay off the loan. Or even if you paid for the property outright from the beginning, you can't seek to be reimbursed and set up a loan at a later date. You can't access construction loans in an SMSF, nor can there be a change of purpose. So for example, converting a scout hall into a medical practice or a residential property into a commercial suite. There are, of course, ways to mitigate these issues, or this issue in particular, so long as you begin planning for that right from the start. It is a more challenging structure and generally a more costly one to allow other professionals to buy into the property, if that's your view, further down the track. Once again, there are solutions, one of which is a unit trust structure. And SMSF is able to own units in a unit trust and acquire or sell units over time. It can also get messy depending on what you buy. There's a concept in super known as the single acquirable asset concept. Essentially, it means you can only own one asset in a trust. So imagine buying a suite with 5 car spaces. If each car space sits on a separate title to the suite, then you would need to set up 6 separate bare trusts, 6 loans and so on. As you can imagine, the cost of this can add up quickly, not to mention the administration of it all. As with all cons though, they may not be an issue depending on your own personal circumstances. Kelly has a different perspective, and hopefully the list of cons is much shorter than the benefits. Over to you, Kelly.
That's right, Craig. You know me, I'm always on the sunny, bright side up. Let me tell you, there's no better tenant than you. You will look after your property the best, you'll take care and be proud of your premises. And no matter what anybody says, first impressions count, and you can likely control all of this in your own place. Secondly, there's a security of tenure. You're not going to have to worry about lease negotiations with the landlord after you've invested significantly in a fit out, and many professions need a serious investment before they can even open their door on day one. No one wants to have to go through all of that process and outlay all those funds all over again upon failed lease negotiations and end up down the road. The third option is the rent piece, which is pretty significant, and we spend a lot of our time talking to our clients about wherever you are now, it's highly likely you're paying rent to someone, whether it be a linked entity or a third party. But if your self-managed super fund owns the property, it would collect the rent plus your concessional contributions each year, presently marked at around $25,000 per member. So if you had a spouse, make that $50,000 per year, extra that you can throw at your loan and pay down quicker than you would outside of this environment. Or retain the cash, invest in other assets and diversify. It's totally your choice. As mentioned, it's a great way to diversify your asset base, but it's also a tax efficient vehicle with lower tax rates on funds on the way in, but also on the way out at the other end. As we lend our clients up to 90% to acquire their premises, they only need to find a 10% deposit and the stamp duties, which we usually say to allow 5% for. So on $1 million property, that's $150,000 all in to get a foot in the door of your own premises. Another key point is the pay down on our super fund loans. We only need 10% paid down every 5 years. So this is basically the equivalent of a 40 to 50 year loan term. On the same basis, with the $1 million purchase and a $900,000 loan, repayments are about $4,900 per month. Compare this to the regular commercial property pay down of generally around 15 years, and you're saving about $30,000 every year on principal reduction that you can redirect elsewhere. Now, we all know that no one's actually going to have a loan for this long, but what it does mean is it gives our clients complete control over their monthly commitment. Of course, under a variable loan, you can repay extra at any time anyway. And I find around June, end of financial year, that most clients are in touch to drop in a lump sum of cash that they've accumulated in their super fund bank account during the course of the year. This solution also helps clients too, because when they're acquiring their premises, as mentioned earlier, they're often in need of a refresh, a refurb, or a new setup. So preserving cash flow to cover these costs outside of this environment is also a very strategic way to approach the overall project. Ultimately, a self-managed super fund is a vehicle used to grow your wealth and asset base for retirement. So regardless if you owe 90, 80 or 50% on a loan, it has no impact whatsoever on the growth and the value of your assets over time. So I think I win that one, Craig. What do you reckon, Ed?
Safe to say you won that one, Kelly. Sorry, Craig. But what I'm hearing here is that the purchase of medical practice premises is really just an investment decision. It's also a commercial business decision. So this is a very technical subject, and we've got two of the very best on our screens, but please do reach out to any of the Credabl squad if you have questions about your own circumstances. Live chat on our website is always a good starting point. Now then, how about you both give us some actual examples then and make it all feel a little bit more real? Craig, how about you first?
Sure, Ed, no problem, with pleasure. So look, I've helped numerous clients with numerous situations over the years. But one that jumps out is a payment structure / loan term scenario. We recently refinanced a client's existing SMSF loan from another lender under advice from his financial advisor. The rationale or benefit to do so was based on the following. Number one, we secured a significantly longer loan period on the new loan as compared to the loan term offered by the client's existing lender. By doing so, this not only improved the client's cash flow position, which is pretty handy in current times, it reduced many of the cons that I mentioned a little bit earlier on, i.e. no ability to redraw repayments or access equity. Ultimately, an SMSF is about growth and creating wealth. By changing the loan term, the client is now able to divert what was being paid off the loan toward other investments. This allows for greater growth of the funds and asset diversification amongst other things, which may well be a requirement of the trustees of that SMSF. I'll hand over to Kelly, who has a few further examples to share.
Thanks, Craig. One example that we've actually done a couple of times, but more recently stands out. I had a client who had built a new family home on their original site. They cleared their personal home loan, their mortgage, years ago, but realising their new dream meant they were going to be left with a new non-deductible home loan to cover the new build costs. So in conjunction with their advisors, we were able to assist with the sale of their already owned practice premises into their self-managed super fund. It obviously led to a chain of events, which ultimately left them with enough proceeds from the sale to clear their existing property loan on the practice premises, but even better, the residual was able to pay out their home loan. A bit of debt recycling, if you will, ensuring that all the loans sat in the right place on their books and their family home is now debt-free, which is obviously a high priority for many of us looking to achieve. Craig's already mentioned another scenario, which I think is particular of interest. This lending situation is not always applicable for everybody and every type of property out there. However, where there's a will, there's always a way. So to get an outcome for clients on a perfect site they'd found for their specialist practice, we had to get a little creative. The block was of residential nature with an original home. So obviously it wouldn't have fit this matrix around change of use. And the property had to be demolished to build the premises. We financed the property actually outside of the super environment to make the build and construction process happen with borrowings. And then upon completion, we had the property revalued and clients sold it into their super fund at this stage with a mix of deposit from their combined retail funds and a loan from us for the balance to their super fund. It's just a couple of examples I could give. I think we could probably spend a lot longer on this topic. We may actually need a version 2.0 of this session. So if you'd like to hear more, thanks, Ed. Hand back to you.
I think as with all of our webinars, the topic is decided by the audience. So if you would like a 2.0 on this session, then please do let us know. Okay, on to those questions then, and please do continue to share any that you have, and I'll get to as many as I can over the next few minutes or so. Just having a look now, the first one actually is for you, Craig, and the question is, how much do you need to establish a self-managed super fund?
Good question. I guess technically there is no minimum. However, most advisors would say that a value of around 250 to 300,000 is like a sweet spot or a minimum. And the rationale being that that's sort of the break-even point between the cost of managing or running a fund versus what you're probably paying already to the retail fund that you already have. Personally, I think a good time to set it up is when you've got a catalyst like buying a property is the great place to start. But if you're really looking to set up a fund that it covers all of your costs, you need to also factor in advice that you should be getting as to how to invest your money. So I'd be going a little bit higher if that was the case. But a great thing about your own fund is you get to control where your money's invested. So there's no exact number, but it does feel like somewhere between 250 and 500,000 seems pretty standard or typical. Back to you.
Thank you, Craig. And actually, Kelly, I've got one for you, and Craig just touched on it there. The question is, it sounds like you need advice to make this happen. Can you help with the advice too?
Sure. I suppose there's two pieces to this. It's obviously a very heavily regulated area. So we're not in the position to provide personal advice as such, but we can definitely share different scenarios that have worked for different clients over time. The key piece to this, I suppose, is given that we have been doing this for a long time, you get access to the team that we have at different institutions. So whether it be the accountants, the financial planners, the lawyers, the valuers also, who can look at options and the viability for our clients. So as much as we physically can't say this is what you must do, we can definitely give you ideas and point you in the right direction. If these are things that are new to you, or maybe your existing providers, it's a little bit outside of their realm. So can definitely help point you in the right direction.
Thanks, Kel. Craig, I've got another one for you. I'm looking to borrow from my SMSF. What are some of the documents that I need?
Okay, so the first thing is you've got to have your SMSF, and much like many of our professionals, they've already got companies or trusts, and a super fund is no different. You need a trustee and a trust. But if you are specifically looking to borrow in the SMSF for a property, what you're going to need is a new trust, or what they call a bare trust, which is something that has never been used before and doesn't own anything else. And of course, you're going to have to make sure you've got the right advice, and that's to ensure that what you're doing is SIS Act compliant or superannuation compliant. You don't want to fall foul and get in trouble for that. But again, speaking to your advisors, lawyers, they'll guide you, and we can also support if you need that guidance as well.
Thanks, Craig. Just to keep alternating, Kel, I'll send this one to you. This is from Van. Thanks for joining us, Van. I have a commercial property. Can I sell it to my SMSF? Do I have to pay the stamp duties for the transaction?
Thanks, Ed. So this is obviously a very similar situation to the one I just explained, how it was a block, and obviously it's particularly difficult and not compliant for a super fund to actually borrow for the construction piece. It's a little bit hard to say without knowing the full details, but there are a couple of solves to that. As Craig mentioned, it might be a structure of a unit trust where the super fund owns those in conjunction with other parties to help make the construction happen. You will definitely need to be looking at stamp duty costs and allow for those in selling it into the super fund too. And it could possibly be a scenario where it's done outside of the super environment and then sold into super on the other side. So there are a few different alternatives, and I suppose it's about working with the advisors and being a little creative as to how we make it happen to make sure it fits, because sometimes the unit trust doesn't work for everybody, and sometimes straight into the super is not going to work, because if you don't have the surplus funds to actually build and construct, because you cannot borrow to construct to the super fund, it's going to fall outside that criteria too. So it's definitely worth a conversation and a closer look to see what else is possible.
Thanks, Kel.
Thanks,
and
Ed.
Please keep those questions coming in. They're flying in. Craig, one for you. We have a block of land and we would like to build a dental practice. Can we use SMSF for the build?
Yes or no answer. I think Kelly touched on it with one of her examples, and I sort of alluded to it. You can ultimately own the property in your SMSF, but in order to construct it, you would need to do it in a structure outside of the SMSF. So be it in your personal name, a spouse's name, or a trust, we could construct it in that entity, and then you would sell it into the SMSF. And I guess it's worth noting that when you sell something from a non-SMSF entity to an SMSF structure, you will still have stamp duty again, much like any form of sale. The title will need to move from one legal entity to another legal entity. What's worth noting though is that, having just done that for a client recently, they received some very unique capital gains tax exemptions or benefits, which significantly exceeded what the cost of the stamp duty was to move it across. But of course, the advice they had was that owning it in the SMSF was right for them in the first place.
Thank you, Craig. And I've got another one in here. Kel, I might send this one to you unless Craig wants to jump in. It's up to you guys. Irrespective of repayments, ability to funnel funds into super and other tax benefits. If you already have a property in your name, what are the entry costs into converting over to an SMSF? And then the second part, specifically, does the title have to change and are the transfer costs the same as if you were purchasing a new building, or is it like the reduced fees between a transfer, say, between husband and wife? So who wants to take that one first?
I'll jump in there, Ed, because it's sort of, I seem to have covered that off a little bit on the land one. So yeah, of course, stamp duty again, entities have to change. I think it's worth noting that other costs would be, you'd have to get a new valuation, there'd be legal costs, loan document costs, etc. And of course, you need a valuation to ensure you're compliant, I guess, with your fund as it comes in, and it's an arm's length transaction. So there may be some other costs such as financial advice or accounting advice that you would want to take prior to moving it in. But again, that's nothing to do with the lending side of things. That's just proper process, meeting your obligations as a trustee of a trust and doing the right thing by your, I guess, the beneficiaries of the super fund. But, you know, it seems like someone's got a very particular example there, Ed. We'd be more than happy to take that one offline and have a chat to them directly. They are welcome to reach out to us.
Absolutely, Craig. Well, look, I think our time is up. I think we've covered all the questions there, sometimes a couple of times, but that's all good. Thank you all very much for your time today. SMSF, well, it could be for you. I guess it's down to contacting the team at Credabl and understanding what your own options are, as there is plenty of choice. Those who have registered to watch us live, thank you, and keep an eye on your inbox as we'll send out our guide to self-managed super fund lending ebook, which we've mentioned a couple of times. If you have any more questions or messages, please continue to use that live Q&A section for the next short while, or we're always about on live chat on the website. Darkside Craig and Lightside Kelly, thank you. As always, lovely to hear from you both. And if you'd like to stream any of our previous conversations, then we have a growing library of fantastic content for you. They're all on the website now, where all of our blogs live. We hope you enjoyed the technical conversation today and look forward to seeing you at the next one. Thank you.